Hey everyone, Bill Constain, Freedom Wealth TV, and welcome back to our next episode. For all of you that are brand new, welcome to the channel. If you haven't done so already, please hit that subscribe button so you can get more content on how to create financial freedom for you and your family. So, topic of the day, characteristics of wealth accumulation vehicles. As the owner of Freedom Wealth Services now for 25 years, we've had a lot of wealthy people we've interviewed over a period of time, clients, and we asked them, what are the best or most important characteristics or qualities of an investment or a savings account? So we're going to go over those today. You'll see wealth strategies. Now, there's a whole bunch of them. Some of the common ones, are bank instruments like savings accounts and checking and CDs. And then, of course, you have your investments, your IRAs, 401ks, the mutual funds, stocks, your home, CDs, bank savings, annuities, real estate, and then this one here, which is permanent life insurance. And the one we're going to feature today is the indexed universal life. We'll be talking about that today. Stocks you could have in the form of a mutual fund in here, which is non-qualified. And then here, these are qualified assets, meaning that you're deferring taxes to a future date. Here, you're paying taxes every single year. So let's go through them. It's a comparison of what you want versus what you're offered. First thing I want to say about financial planning is that you should plan. Now, if you're doing this on your own, that's fine. If you're going to an advisor and they're just selling you their favorite product or service, might make you a little suspicious. I call that financial malpractice. You want to do the x-rays. You want to be able to ask questions, just like you were going to a doctor's office to learn about what's important to you, what your risk tolerance is, what your goals are, all those things. So here we go. This is what we share with our clients. So wealth strategies, risk. Do you like risk? Do you not want risk? Guarantees on your money. Penalties, meaning that if you take the money out early or you cancel, will you pay penalties? Liquidity, use, and control means that you have access to the money or do you get charged for it? Protected against lawsuit, IRS, slip and fall in front of the house, car accident. Is your money really protected? Leverage, be able to use that money to leverage it towards the purchase of businesses and real estate. Tax deferred, meaning that you can not pay the tax this year, but pay it sometime in the future. And then tax free, be able to pull that money out tax free. Wouldn't that be great? And then collateral, be able to use that money for to qualify for loans and such. Tax deductible payments. When you save money, can you get a write-off this year? Disability benefit. If something happens to you, can you get a benefit? Do you have to keep paying fees, or do you have to keep saving, or do you have an account that will save for you if you have a disability? And lastly, a wealth transfer. You pass away, what happens to the money? Goes to loved ones. Do you want that money to be inherited, taxable, or tax-free? Well, let's see what you want. Risk, preferably, we'd like not to have risk. Guarantees, if given a choice, hey, we like guarantees, right? Penalties, who likes penalties? We hate penalties. Access to the money, yes, we want access to the money. We prefer to have it protected. I can tell you, my dad taught me early on, he said, son, one mistake can ruin your life, right? So here you are saving money, you're a professional, you're a business owner, and all of a sudden some kid slips and falls, someone slips and falls in front of your property, now you're in the middle of a lawsuit, or car accident, something happens, all of a sudden your assets are exposed. So I don't like having assets exposed, I like them protected. So as you go through all of these, risk, right? We don't want risk, but an IRA, 401k has a lot of risk. Now you can choose to be in something more conservative, but then you're not participating in the marketplace. So you lose the potential growth. Mutual funds have risk. Your home has risk. That's more of a lifestyle decision. The home, CD bank. CDs, banks and savings, typically no risk unless they are connected with some sort of, equity CD of some kind. Annuity, it's possible. It depends on what we're talking about here. What type of annuity? Is it a variable annuity? Is it a fixed annuity? Is it an indexed annuity? I do like annuities for some people, especially as they approach retirement or they're looking to save for the long term. Also, annuities can be very good in an IRA rollover. I don't like the variable annuities because you don't have the guarantees. The fees are very high. And the indexed annuities can be very good, and it has to be for the right person. Real estate, yes, there's risk. And now, as we look at index universal life, no, there's no risk, there's no downside. Zero's your hero. The market can be down 10, 20, 30%, contractually guaranteed never to lose money here. So guarantees, you can go across the board. Yes, what we want the guarantees. So, and then you could see across the board as you measure. Now, I'm not saying that you should just have one of these, but having a diversified portfolio. Also, think about taxes and access to the money, penalties, IRA and 401k. It's real simple. Prior to 59 and a half, you're going to have to pay a 10% penalty unless you are using it for education or you're using it for your first home purchase. 59 and a half, 10% plus taxes, your income tax. Mutual fund, usually penalties there, and so forth. The index policy, sometimes there are penalties if you surrender the policy early, which I do not recommend. Whenever I have a client that says, how about if I just get rid of the insurance policy in a few years? If that's your mentality, you should not be buying an index universal life policy. It is in for the long term. And if you manage it properly, you will have tax deferred, and I'll show you in a minute, tax-free growth. Liquidity use and control. What about using the assets to be able to buy a car for real estate? That's going to be important, especially if you're younger. Protected. Look at that. As you look at the different assets, 401k, mutual fund, home, CD, annuities, real estate, and then the index policy. I love it because it's safe money. It's not an asset where people can grab a hold of it in a lawsuit. Protected. Leverage. Again, we could leverage it here. These others we cannot. Tax deferred. We can grow that money tax deferred. That's why people love the IRA and 401k. But this is what I have to say about tax deferral. Another word for deferral is delay or postponement. Is it good? Well, here we have deferral also. Yeah, we like to defer it, but eventually, do you have to pay taxes? Here you do. And what bracket will you be at? That's a future unknown debt if you have to pay taxes in the future. Tax-free, the home and the real estate, there are some IRS limitations. Here in the index policy, you can get it tax-free in the form of a loan that can be deducted from the death benefit. If you have other questions, you can put it in the comments here. You also can email me your questions at info@freedomwealthservices.com. We also have a service where we review policies to make sure that they are in concert with what you're looking for, that the fees are right, and that they were projected properly, and that actually will last. A lot of these policies haven't been structured properly. Tax-free, collateral, tax deductible. That's what we like with the 401k, IRA. I get it. But it's kind of like the farmer. Would you rather get that deduction up front when you buy your seed as a farmer, if you're planting corn or wheat, or when you come to harvest? Do you want that tax-free? Most farmers would rather get the tax out of the way. It's kind of like if you're buying a house and you qualify for a mortgage. The bank says, listen, I've got great news for you. You qualify for the mortgage, but we just don't know what interest rate we're going to charge you, and we don't know what your monthly payment's going to be. Would you accept that mortgage? Would you sign the contract with a bank that told you they didn't know what your interest rate was going to be for the next 30 years? Well, that's what people do all the time with their 401k and IRA. They don't know what their future tax bracket's going to be. So if you're in one of these 401ks and IRAs, that's fine. I just wouldn't put all my eggs in that basket because right now taxes are low compared to historical equivalents. Right now, we are way below the median, and I can show you that on my ebook where I kind of track what's going on historically. Taxes started in this country in 1913, and this country launched in 1776. So give me a comment. How many years were we not being taxed? How many years were we not being taxed before 1913? Let's see in the comments here. It's a long time, right? And we started at a low 1% and it escalated into the 90s. And now we're in the 20s and 30s, but the median is close to 60%. So what do you think? I'd like to see it in the comments. Do you think future tax brackets will be the same, lower, or higher in the future? And how do you think that will impact your 401k and IRAs? Love to see what you think about that. Let's get the conversation going. That's a big subject. Collateral, yes, we do things, business, real estate. You want to be able to access the money, tax deductible payments. Then the disability. This is a big one, especially if you're young, you're in the workforce, you're in your 20s, 30s, 40s, even 50s. You want to have a strategy that if you can't work, could you still save money? Wouldn't that be great? You can't work, but you're still getting paid. I see a lot of red here. I see one green, and that's the index policy. And then wealth transfer. Many of you are young watching this, but a lot of you are already in your 40s, 50s, 60s, 70s, maybe even 80s, and you're already thinking that, hey, this money may not be for me. It's going to be for a family and loved ones. Do you want that money tax deferred and then your family to pay taxes on the money on these mutual funds, IRAs, and real estate, maybe even estate taxes, or do you want it tax free to your family? So that's the review. Freedom Wealth Services. Here's the phone number. Here's the email. I'm the CEO and founder of the company. I hope you enjoyed this video because we've interviewed hundreds of people, wealthy people, and those are the characteristics that they're looking for. If you think we missed something, please let us know. If you liked, loved the video, go ahead and give us a thumbs up, a positive comment. Again, tell me what you think. Will taxes in the future in the United States be the same, the tax bracket be the same, less, or higher in the future? Okay, my friends, it's been Bill Constain, Freedom Wealth TV. Please go ahead and hit that like and give us a positive comment and subscribe, and we'll see you on the next video. God bless and have a great day.